Most people think AI is the safest investment opportunity of the decade. But history shows that when everyone believes an investment can't fail, that's usually when it does. This is Zero to Wealth. I break down money and investing topics in a calm, realistic way, without hype, without panic, just clear thinking. Today, we're talking about something important. Not whether AI is real, not whether AI is useful, but whether today's AI investing frenzy is starting to look dangerously familiar. If you invest in stocks, index funds, retirement accounts, or even crypto, this matters to you. Because bubbles don't announce themselves. They feel like certainty right before they break. Let's walk through this slowly. Imagine it's 1999. Your coworker is making money on tech stocks. Your cousin doubled his portfolio in 6 months. News anchors say the internet will change everything, and they're right. So you invest. Because not investing feels like being left behind. Then, in 2000, the market crashes. And suddenly, all that easy money disappears. Fast forward to 2007. Housing prices only go up. Banks approve anyone. Homeownership is called the safest investment you can make. Then 2008 happens. Now, in 2026, we have a new story. AI will change everything. AI is the next industrial revolution. AI companies will dominate the future. And again, they're not entirely wrong. AI is transformative. Just like the internet. Just like housing was essential. But here's the uncomfortable truth. Technology can change the world. And still be part of an investment bubble. That's the problem. Most people don't lose money because they choose the wrong technology. They lose money because they buy the right story at the wrong price. So today, I want to walk you through 3 specific investing risks in the AI boom that could quietly crash portfolios in 2026. Not to scare you. Not to tell you to avoid AI. But to help you see the risks clearly before the crowd does. Before we get into the 3 risks, let's understand why bubbles happen in the first place. A bubble forms when expectations grow faster than reality. Prices rise. More people invest. Media coverage increases. Fear of missing out spreads. This creates a feedback loop. Price rises, attention rises, more buying, price rises again. Eventually, valuations detach from actual earnings. In 1999, many internet companies had no profits, a minimal revenue, massive valuations. In 2021, many crypto tokens had no cash flow, and no real utility, billion-dollar market caps. In both cases, the story was real, but the pricing was fantasy. Today, in AI investing, we're seeing early signs of the same pattern. Let's look at a simple comparison. In 2023 to 2025, major AI-related stocks saw price increases of NVIDIA, over 400% in 2 years. Certain AI software firms, 200 to 600%. AI-related ETFs, doubling or tripling. At the same time, many of these companies saw revenue growth far slower than stock growth. Profit margins under pressure. Rising competition. This gap between price growth and business reality is where bubbles live. Now let's talk about the 3 specific risks that could bring this back down to earth. Risk 1. Valuations detached from earnings. Let's start with the simplest risk, price versus profit. When you buy a stock, you're buying a claim on future earnings. If a company earns $1 per share and the stock trades at $20, that's a price-to-earnings ratio, P, of 20. Historically, the U.S. stock market averages a P/E of about 15 to 20. During the dot-com bubble, tech stocks traded at P/E ratios of 100, 200, sometimes higher. Today, several major AI-driven companies trade at extremely high forward P/E ratios, in some cases above 70, 80, or even 100. That means investors are paying today for profits that may or may not arrive many years from now. Here's the risk. If growth slows even slightly, if earnings disappoint even a little, prices can fall sharply because the valuation was based on perfection. Let's make this real. Imagine 2 companies. Company A earns $10 billion per year. Grows profits at 10% annually. Trades at APE of 20. Company B. Earns $2 billion per year. Grows profits at 40% annually. Trades at APE of 100. Company B sounds exciting. But if its growth slows from 40% to 20%, investors may no longer justify paying 100 times earnings. The stock can fall, even if the company is still growing. This is one of the cruelest realities of investing. A great company can still be a terrible investment at the wrong price. During the dot-com crash, Amazon lost over 90% of its value. Cisco lost over 80%. Intel lost over 60%. These companies didn't disappear. Their businesses survived. But investors who bought at bubble prices waited many years just to break even. Today, AI leaders are incredible businesses. But many are priced as if growth will remain extreme. Competition will stay low. Margins will remain high. And no regulation will interfere. That's a lot of assumptions. When expectations are that high, reality has only one direction to surprise: downward. That's risk number 1. Risk 2, every company claims to be an AI company. The second risk is quieter, but just as dangerous. During the dot-com era, companies added .com to their names and saw their stock prices triple, even if they had no real internet business. During the blockchain boom, companies added blockchain to press releases and watched their valuations explode. Today, we're seeing something similar with AI. Companies across every sector now describe themselves as AI-powered, AI-first, AI-integrated. Some of these are real. Many are marketing. This creates 2 problems. First, investors struggle to separate true AI infrastructure leaders from companies just using the label. Second, when too much capital floods into one theme, weak businesses get funded alongside strong ones. Eventually, reality sorts them out, usually violently. Let's look at an example. Right now, venture capital funding into AI startups is massive. Tens of billions of dollars per year. But most startups will fail. That's normal. The problem is when public market investors start treating every AI-related stock as equally inevitable winners. This leads to what we call theme investing. People buy the theme, not the business. When the theme cools, everything in the basket falls, including good companies. We saw this in .com stocks, cannabis stocks, EV stocks, crypto mining stocks. The pattern is always similar. New technology excites investors. Capital floods in. Weak companies ride the wave. Reality arrives. Most stocks collapse. A few survivors dominate long-term. AI will likely follow the same arc. The danger in 2026 is that many portfolios are now heavily concentrated in AI ETFs, tech-heavy index funds, individual AI stocks. When sentiment shifts, correlations rise, meaning everything falls together. That's risk number 2. Risk 3, regulation, costs, and physical limits. The third risk is the one almost nobody talks about during bull markets: constraints. AI is not just software. It requires massive data centers, huge energy consumption, specialized chips, or rare materials, global supply chains. These are physical limits. As AI adoption grows, so do costs. Data centers already consume around 2 to 3% of global electricity and rising. Governments are beginning to ask, can power grids handle this? Should AI energy use be taxed? Should AI development be regulated? Who owns data used to train models? Any one of these can slow growth or raise expenses. Higher costs mean lower profit margins. Lower margins mean lower valuations. At the same time, governments around the world are drafting AI regulation frameworks. In the US, in the EU, in China, regulation can slow product rollout, limit data access, increase compliance costs. None of this kills AI, but it challenges the assumption that growth will remain frictionless. Bubbles often form when investors imagine a future with no obstacles. Reality always adds obstacles. That's risk number 3. At this point, you might be thinking, so, should I avoid AI investing completely? Here's the turning point. The lesson is not that AI is a bad investment. The lesson is that great technologies do not guarantee great investment returns, especially when everyone already believes the story. In 1999, the internet was real, but internet stocks were overpriced. In 2007, housing was real, but housing debt was overpriced. In 2021, blockchain was real, but many crypto assets were overpriced. Now AI is real, but some AI investments are overpriced. Recognizing that difference is what separates long-term investors from short-term speculators. This is where we shift from fear to strategy. Let's walk through practical, beginner-friendly steps to navigate this. No hype. No panic. Just calm risk management. Step 1. Don't bet your entire portfolio on one theme. If AI is 5 to 10% of your portfolio, volatility won't destroy you. If AI is 50 to 80%, a downturn becomes catastrophic. Small exposure keeps you in the game, without risking everything. Step 2. Focus on cash flow, not just stories. Before buying any stock, ask, does this company already earn money? Are profits growing? Are margins sustainable? If the only justification is AI is the future, that's not enough. Step 3. Avoid chasing parabolic price moves. When a stock is up 300 to 500% in a short time, expectations are already extreme. Buying after euphoria is how bubbles transfer wealth from late buyers to early sellers. Patience is an investing edge. Step 4. Prefer broad market index funds. If AI truly transforms the economy, broad index funds will benefit too. This gives exposure to winners, without needing to guess which ones. Step 5. Rebalance regularly. If AI stocks grow too large in your portfolio, trim back to your target allocation. This forces you to sell high and control risk automatically. Step 6. Keep cash for opportunities. When bubbles burst, great companies go on sale. Cash gives you flexibility when others are forced to sell. Step 7. Think in 10-year timeframes. Short-term crashes feel dramatic. Long-term wealth is built by staying consistent through cycles. The goal isn't to avoid every downturn. The goal is to survive them. Most people overestimate how fast new technologies change profits, and underestimate how powerful patient investing becomes over decades. AI will reshape industries. Some companies will become giants. Others will vanish. Your job as an investor is not to predict every winner. Your job is to avoid permanent losses. Bubbles come and go. Disciplined investors remain. The hardest part isn't picking the perfect stock. The hardest part is staying calm when everyone else is certain. Because in investing, certainty is often the warning sign. If you found this breakdown helpful, I share more calm, practical investing discussions like this every week. No pressure, but if that sounds useful, feel free to subscribe. Thanks for watching, and I'll see you in the next one.